Hi, this is Dan with Invest Rent to Own. I thought I'd give you my ideas on this article from Forbes magazine that's online from September that talks about 11 predictions for the real estate market going forward. It's dated in September 2021, so pretty relevant, and it's got some pretty good stuff in here, some of which I agree with, some I'd like to amplify. And so I thought you'd be interested in my thoughts on these real estate predictions. This first one is about less urgency to buy. I mostly agree that there will be less of an urgency of buyers to buy going forward as COVID begins to ratchet down a little bit and we get it more under control as the supply chain things get sorted out. There will be less urgency to buy. The only exception to that, I think, is probably millennials that have been putting off their purchases for so long. Those ones will be driving market with urgency. There will also be not necessarily urgency to buy. There still maybe some urgency to move as the eviction and foreclosure moratoriums sundown. There will be some movement of those people that need to get evicted or end up getting foreclosed, and that will drive still some urgency, but those are probably not your likely buyers. They're just going to be renters of sorts. So there's still going to be some urgency on that factor. And the second one is workforce home buying challenges. I generally agree with this idea that, but I don't, the call to action in this one is that they need some kind of policy, that means some kind of federal policy in order to overcome the home buying challenges that have been created as a result of COVID. To me, what I do think that this means, though, I don't think we need a policy necessarily. Renters will be renters, or if you want to create more home buyers, then really what you need to do is you need to teach more financial acumen so that those people can begin to save and begin to know better how to spend their money. So that they're able to own houses. Just throwing a house at somebody without the right level of financial understanding is just a recipe for disaster. And we found that, a decade and a half ago as we tried to increase home ownership without creating the right conditions for us. But what this does tell me is that workforce home buying challenges, these are your blue-collar people that we desire for them to buy homes, but more than likely they're going to be your renters. And so I see that there's going to be a growth in renters, and I think that this was even a forecast from before COVID, and so I think that will continue. Number 3 talks about that the markets will appreciate. I agree that the markets will appreciate, and what I see here for the markets is similar to what this individual talks about. They talk about 3 things driving the market, and those are scarcity. This particular article estimates that we are a $6.8 million homes short of what we need in our population today. So that alone, a limited supply means a higher price with the same amount of demand. The second is increased utility of the home. What he particularly points out is that the home has become not just a place where you sleep and that kind of thing. It also is a place where you work, a place where you go to the gym potentially. And so with all these movement towards home-centered offices, there's also a movement towards a lot of home-centered things. And so that increased or desire to have more utility in your house will create more demand, which will appreciation. And last one, this points out something that I pointed out earlier and in other videos about that there's an increased demand because of millennials, that they're the majority of that bow wave of those aged people are approaching 30 years old, which is prime buying years. Number 4 talks about fewer showings and offerings. I generally agree that there will be fewer showings. There will be less frenzy in the marketplace is what I would say is my comments on this particular one. More out of the fact that those buyers are potentially just more tired with constant offerings and constant multiple offers, and so seeing a little bit of market exhaustion in that case. Number 5 talks about the demand for multifamily that will increase. I think that that's consistent with the growth of more long-term renters, so I agree that that will be a situation that we'll see going forward. And an investor in multifamily as well, I definitely see the effects of that in the multifamily that I already own. Number 6, housing prices will become unaffordable. I generally disagree. This seems like hyperbole to me, where they're extending this way past. Yes, it is true that as prices go up, that you incrementally have less and less people that can afford it, but this is also, you're seeing some good wage appreciation during this period of time, so I think that that's going to balance things out a little bit. You should also see some lower priced areas of the country get a benefit from this. So my strategy is that I'm not buying in the big cities. I'm buying in the Midwest areas. Think about it for a minute. If you can work any job from any house in the United States, why would you pay 2 to 3 times as much and live on the coast when you could move inland, just get just as good enough schools for your kids and work the same job as you would? Your dollar's going to go farther, and you're going to get a better house, a bigger house, more amenities. So I think that those inland locations that are more affordable are more likely to appreciate faster than those areas that are on the coast. The coastal areas will become more the vacation areas and less of the living areas, and the inner will be driving job growth and therefore more at home working in those locations. They'll see a greater appreciation. Number 7 is about market cooling and new investors. I agree that as interest rates go up, you will see less buying go on, but I disagree that it's going to cause a crash or anything like that. Consider the motivation that the politicians and the Federal Reserve has in keeping interest rate low with regard to the national debt that's over $20 trillion now. There's a much greater effect when that goes up by 0.1% or a full percentage in what it means for paying our national debt than it is about affordability payments of a 3% mortgage versus a 4% mortgage for a house. I think that somebody that could afford a 3% mortgage and couldn't afford a 4% mortgage is likely still to be able to overcome that with a little bit more down payment, much easier than the national debt is able to be covered with the trillions that. So I somewhat disagree that the market will cool considerably as interest rates generally rise, which is a trend that I agree is likely to occur. I do also agree that we are likely to see more investors enter the marketplace. It's usually more about what the pool of investors can invest in. And so if the stock market goes some different directions, like for example, if the stock market were to go down, then you are more likely to see people pivot their money towards something like real estate or other investments. So I think that's a possibility. Also, as you see good press coming about the appreciation in real estate, that's going to draw more people. You see people are always following the latest last trend instead of trying to get ahead of a trend, and so you will see more investors follow that as a result. So I think that that's got a positive increase of buying because you see more investors coming in. Number 8 talks about the market is shifting towards a balance. I do agree that coming out of COVID, there was some pent-up demand, and that has definitely thrown us much more out of whack. I do think that we're still generally going to be out of balance with a lot more buyers, and so it's still going to be a seller-driven market, but we're just going to not be as out of balance as before. Number 9 talks about that technology will have the ability to drive more value to the real estate. I kind of think that this is a gee whiz duh answer, in the fact that, of course, technology is going to bring more value no matter where you apply it. So I don't think that this is really about what is going to happen in the future market as a result of technology. We'll continue to apply technology the greatest ways that we can to sell more houses. So, duh. Number 10, it talks about commercial. I really don't care. I don't invest in commercial real estate other than multifamily. So I really didn't pay attention to that. And number 11 talks about more renters, which I agree with. There will be more renters going forward because there's been more of credit shakeups that have come from COVID. And so I think that that's going to continue going forward into 2022 as well. Again, my predictions going forward is that we're going to see a robust market going forward. I anticipate we probably won't have record-setting appreciations in areas like we did in 2021, but we'll still see steady appreciation. An area that went up 20%, I imagine will go up 10 to 15% this year. Or a place that went up 40% may end up being flat because it went a little bit too high. Or it might still go, half of that. But I doubt that we'll be setting new records, except in those places where we're seeing migratory effects of people moving from one location to the other for COVID. I hope that you learned something today. I hope that it causes you to read this Forbes article and get your own grill working in your brain as to whether or not you believe with these market predictions or not. I encourage you to subscribe to my channel and to like this video, and I'll put out more about market conditions coming soon.